Hello, everyone. Welcome back to another lesson, Unit 1, Lesson 11. And today we're going to be talking about risk and return. So, without further ado, let's get into it. So, every investment really comes down to two questions: what can I earn, and how sure are you of earning that? Basically, risk and return. You may have seen a version of this already with asset classes, like cash is fairly steady, bonds move more than cash, stocks move a lot more than either one, and investors expect more return in exchange for that. So stocks, you carry more risk, but because of the higher risk, you want higher returns. Look at this chart on the right here. Cash, moving right means more, and moving higher means you have more expected return. Cash is pretty low, right in the bottom left corner. Stocks sit really high. You have a bunch of risk, but you also have the opportunity to make a bunch more money. And bonds sit right in the middle. This is a lesson we're about to learn of why these things travel the way they are. Why is stocks here, not here? And things like that. So, first we have to ask the question, what finance actually means by risk? When most people hear the word risk, they think about losing money. Finance means something a lot wider than that. Risk means uncertainty about the income. Take these two lines on the screen. Investment A lands somewhere around 4%, and we are fairly confident about that. Investment B could gain, however, 20%, 5%, or lose 15%. B has more risk because the spread is much wider, right? 4%. Boy, we have this range of 20 to 15%. That's a way larger course. That 20% gain counts as part of the risk. Risk is not only the bad side, it is how many different things can happen. And later in the course, once we get into statistics, we'll actually measure the spread using mathematics, but that's way later down the line, Unit 5, etc. Next thing. Why investors actually expect more return for more risk? Put yourself in an investor's shoes for 1 second. You have two choices in front of you. One of them is safe, and one of them is risky. If both pay the same exact return, which one you take? The safe one, right? It makes no sense. If I have two assets, asset A is extremely risky, and asset B isn't risky at all, but both make 10% a year, which one am I going to pick? The less risky one, of course. Why would I not pick the less riskier one? It just makes sense. So, if the risky investment has nothing extra to offer, no one buys it. The extra is a higher expected returns. Stocks have historically paid more than bonds or cash, and stock returns have also bounced a lot more than cash or bonds. The extra return is payment for putting up with that. It isn't a guarantee, okay? If a higher return was guaranteed, it would not be risky in the first place. That's the issue. You can expect to make more money, but you can also expect to lose a lot more money. That's the key idea. Now let's talk about the risk-free rate. To compare with anything, you really need a starting point. We talked about this in the indices units where we compare portfolio returns against our indexes, like the S&P 500 index. In this case, we also do something like that too. Finance uses the risk-free rate. That is the return that you can get while taking almost no risk. In practice, we use short-term U.S. Treasury bills as a reference. Say those bills are paying 3%. That 3% is our baseline. If I can earn 3% for almost no risk, then anything riskier has to beat 3% and beat it by enough to be worth the trouble of having to take on that risk. Whatever it pays above the baseline has a name, and it's called the risk premium. Now, risk premium, let's talk about that a little more. The risk premium is the return you expect above the risk-free rate. The formula is here on the screen. Risk-free rate plus premium equals expected return. Say the risk-free rate is about 3%. Here we are. Say the risk-free return is about 3%, and investors want another 6% to hold a stock. The expected return works out to be 9%. You can run it backwards too. If an investment has an expected return of 11% and the risk-free is 4%, then the premium is 7%, right? 11 minus 4 equals 7. The arithmetic in math is pretty easy. The idea underneath it is what really matters. That's the key idea. The safe return is the baseline. The bond is the baseline, and investors want more than the baseline before they will on to take risk. Easy as that. Let's talk about expected return a little more. This is a term that's pretty important. I threw around a bunch, but we're going to slow it down here. We're going to talk about it. Expected return is not what you are guaranteed to get. This is the average of what could happen across different possible outcomes. This is statistics. We'll talk about it way down the line, but that's the key idea. So a stock with a 9% expected return can still lose money this year. It can also do a lot better than 9%. Expected return describes the average, not the next 12 months. That is why risk matters so much. The wider the range of possible returns, the less the average tells you about what you actually will earn. Now, there are actually two main types of risk: systematic and unsystematic. Now, there are many different names for those, like there can be called market risk, specific risk, but for sake of this lesson, systematic, unsystematic. So, the first is systematic risk, also called market risk. It hits most of the market at once. So, a recession does this, for example. And so does large jump in interest shares and a bunch of other factors. If you own 50 different stocks and the whole market drops, owning 50 does not help you. To think about systematic risk as something that affects the entire market. It could be anything. Like I said, a recession, a pandemic, something that affects every stock, or at least most of them. It's called systematic risk. The other one is called unsystematic risk, and pretty obvious, it's the exact opposite of systematic risk. This one belongs to a single company or an industry. Maybe a company has a major product recall, or a factory burns down, or the CEO gets caught committing fraud. It can be anything. Those events hurt the company, but they do not drag the entire market down with them. That's the idea. You will always have systematic risk. It's not impossible to get rid of it. You have it. Unsystematic risk, you don't have to have. And this is where diversification plays a huge role. Put all your money into one company, and the scandal at the company hits every dollar you own. Spread it across 50 companies, however, in different industries, and the same scandal hits one, holding out of 50. This is what these two blocks show right here. One solid square versus one solid square traded in 50 different squares, out of 50 different squares. So, diversification cuts down the specific company-specific risk, the unsystematic risk we just talked about. What it cannot do is remove the market risk, systematic risk. So in a recession, when all stocks are falling together, owning more stocks does not protect you. This is a very key idea. Diversification helps you eliminate one type of risk, and that's unsystematic risk. The risk of holding one company, and that one company does something bad happens to it. If you own multiple different companies that are all influenced by different factors, that will help your portfolio reduce your risk, because companies are being influenced by different factors. So thus, if one company is influenced by one factor, that does not mean every other company is influenced by that factor. However, systematic risk is something you cannot get rid of, because that affects all 50 companies. If there's a pandemic, that hurts everyone. Something like that. Now let's work through some examples classifying different types of risk. A nationwide recession hurts businesses across the country. That affects the whole market, so it is systematic risk. Interest rates jump and stocks fall across the market, also systematic. The CEO of one company is caught committing fraud. That problem belongs just to that company, so it's unsystematic. And another example is a drugs company, new drug fails its clinical trial, fails. So it's the same idea, it's unsystematic because it only affects the company. Okay? Next slide. So, let's talk about which risks are worth taking. Investors want to be paid for the risk they take, and that is where the distinction earns why it matters. Holding one stock loads you up with company-specific risk, systematic risk, as we said, but you do not have a high expected return just for concentrating everything in one place. You could have reduced that risk by spreading out, diversifying your portfolio, but you chose not to. Market risk is different, however. You cannot diversify yourself out of it. However many stocks you own, you will always have to deal with systematic risk or market risk. That is why the split matters a lot more when you actually start building portfolio's later in the course. Actually, in the last lesson of the unit, you're going to build your own watch list. That's the key idea. Systematic risk, unsystematic risk, you can get yourself out of. Just diversify. Systematic risk, you can't. You have to deal with it. So, let's go ahead and do a little recap, and that's that. 4 things you can take away. Risk in finance means uncertainty about the outcome. A riskier investment has to offer a higher expected return, or investors just won't buy it. We start with the risk-free rate and then add a risk premium on top. Risk-free rate plus the rate premium equals expected return. And there are 2 kinds of risks. Systematic risks hit the markets broadly, and you cannot own your way out of it. Unsystematic risk, however, belongs to individual companies, and diversification reduces it. That's that. I hope you enjoyed this lesson. I hope you learned something new, and I'll see you in the next one. Bye-bye.